Greetings from Three Edge Asset Management. My name is Fritz Folts, and I am the Chief Investment Strategist here at Three Edge. Pleased to be joined here today by Steve Cucchiaro, President and Chief Investment Officer of Three Edge Asset Management. Today is Saturday, April 25th, and as Steve and I have done each week during the COVID-19 crisis, we'll be providing a summary of the past week in the global markets. In terms of what transpired last week in the markets, on Friday, the S&P 500 gained just shy of 1.5%, but the index still finished down over 1% during the week. Meanwhile, total job losses in the U.S. in just the last month have now reached a staggering 26 million individuals, reflecting the enormous degree of damage to the U.S. economy from the COVID-19 global pandemic. And to provide a little bit of context there, since the financial crisis in '08, the U.S. had created approximately 20 million jobs. So all of those gains gone in less than a month. Another thing I found interesting this week was that now we're in the corporate earnings season, when corporations report their earnings for the prior quarter and provide guidance as to their outlook for the year ahead. And this week, Intel Corporation joined a growing list of companies who are simply not providing any guidance on their potential future earnings for the next 12 months. Now, in a normal environment, such a move could send investors into a frenzy, but it just seemed telling in terms of the degree of uncertainty that lies ahead. But Steve, it probably makes sense for us to briefly cover what we saw happen in the oil markets over the course of the past week. On Monday, the price of a barrel of West Texas crude in the futures market went negative, signaling that buyers of oil would be in a position to force sellers to pay them to take their oil off of their hands. The price has stabilized, but it's still historically low. So my question is, could the low oil price be a canary in the coal mine?
So again, another unprecedented scenario. But the actual negative price for oil, which I don't think any of us ever thought we'd see, had to do with an expiring futures contract where anyone who held that upon expiration was forced to take delivery, and there wasn't any storage facilities readily available. So people get out at whatever price they could. Having said that, though, from last year to now, oil prices are down over 70%. So I agree, this is very much, for it's a canary in the coal mine. And it's a sign that is going to expand beyond the oil market of being a leading indicator as to how much economic demand is crushed.
Very good. So talking again about the U.S. economy, I mean, the damage to the U.S. economy so far from COVID-19 is undeniable. It's been sudden and very steep. And so I guess the question for investors is, as the U.S. economy begins to reopen, which we're starting to see as of last week, maybe state by state, will that recovery also be sharp and steep as the decline was? And what might we look for here to get a signal whether it was going to be sharp and steep or a longer slog?
Well, we do have some early signs we can look at. Elsewhere in the world, there have been attempts at opening before we are now starting to. So we can learn from those experiences. And so far, the lesson has been that consumers remain cautious. They appear to have a newfound desire to save more after going through this trauma. And people generally still feel unsafe knowing that there's no vaccine available. Now, there's some good news. And one piece of good news is that R naught is less than 1. And what that means is it's a statistic that all the data scientists look at very carefully that tell whether or not the infected person is infecting greater than one other infected person through the contagion. And that had been the case for most of this period. And that means you get an exponential rise in cases. The good news is that R naught now is less than 1, meaning that our latest estimate at the IHME is that countrywide, our deaths per day have peaked 10 days ago. And they're now declining quite rapidly because the rate of infection is less than 1. And it looks like this first wave, not for every state, but for most states, this first wave will generally be over in the late May period. So that's the good news. Now, balancing that, there is a high likelihood that we will have a second wave. And I think that causes some of this concern and will act against this idea of a sharp recovery. But also, it's going to be a time, Fritz, where I think there's going to be a premium on people's ingenuity, on innovation, on the ability to adapt. And that would be an optimistic view that we can get out of this eventually.
Absolutely. One thing that we often say is don't confuse the economy with the market. So, as we keep our eye on the economic recovery, what should investors be watching to determine the future direction of the markets? And is it dangerous to just assume, as we sort of have over the past decade, that with the enormous amount of global monetary and fiscal stimulus, has that now put a floor under the equity markets yet again, and there's no need to revisit the lows that we experienced in March?
Well, there's just so much uncertainty. There's such a gap, as we mentioned previously, between the optimistic and the pessimistic scenario. And so rather than look at some of the speculation, we have two known facts. One, we know we are in a severe recession today. And
Right.
two, we know that we have seen extraordinary bailout packages from the federal government, where the government went even further out in debt and borrowed literally trillions, had the Federal Reserve Board buy that debt, put it on its balance sheet because the market wouldn't be able to absorb that so quickly. And in that process, the Fed is directly manipulating market prices, directly in the bond market and directly in the stock market. So you have this tug of war still. And if you think about the stock market as opposed to the economy, the economic connection is that you would expect if sales and profits go up, the stock market prices would go up. And if sales and profits go down, stock market prices would go down, all else being equal. But we have this situation where we have market manipulation to a very high degree by the Federal Reserve Board by manipulating those bond prices, which in turn manipulate the stock prices, which is why we think the stock market got overvalued even before all this started. So that is one reason why you can see the stock market continue to do well, even though the economy is doing poorly right now. One other point is markets, and you always bring this up, Fritz, markets typically act ahead of what happens in the economy. So by the time the economy gets hit, the markets have already anticipated that have gone down. And by the time the economy starts to recover, well, the market has recovered in advance of that. Now, not to make the market seem like it's always so prescient. Often the market is giving fakes and will start to recover, find out that the economy is still a long way from recovery, and then come back down again.
Right. So excellent. So with that in mind, maybe you could just touch briefly on our current outlook and our portfolio positioning at this point in time.
So let me begin with our short-term outlook. We are not in the camp that expects a V-shaped recovery in the economy. We think that this is going to be a bit of a slog. And we know that even in best case scenarios, it'll be several months before there's a vaccine. So we're not expecting a sharp economic recovery. However, we do know that there are some asset classes that can still either stabilize or benefit from the other dynamics. So we do think there are equity indices that can and have benefited from this market manipulation by the Fed. And also, we think that equities will relatively be strong compared to others who have strong balance sheets. We think gold will be a good hedge against all of this Fed manipulation and expansion of its balance sheet. We also continue to think that people should be very wary of risks in the bond market, particularly corporate bonds, particularly long duration. That even though the Fed has come as a rescue to try to stem the big decline in bond prices that we saw earlier, that doesn't mean that they're going to be there to fix every default situation or every refinancing situation. Here's another known fact we can be absolutely certain. The government debt, not just our own government, but all over the world, government debt is soaring as a percent of the size of their economy.
Yeah.
And to record levels. And so what do we know? Well, how do you get out of that debt situation? One way is to grow your way out. But we know that when debt gets to such extraordinary levels, history has shown, research has shown, that growth becomes constrained. So what are your other options? Well, who owns this debt? It's the taxpayer. So a direct option is you raise taxes, but then that could further hurt your growth. Or what a lot of times happens is it's a more of a stealth tax increase where you devalue your currency. So people actually paying their taxes in the form of the wealth they hold is not worth as much because the currency is being devalued. Or you create inflation. So the dollars the government's paying back on the debt are worth less than the dollars they got. Or you have a period of financial repression where the government artificially lowers the interest rate so the government can pay their debt at a much lower than market interest rate. And then the people who are effectively getting taxed are the people who are buying the bonds and getting an unfair interest on them. So we think long term, yellow would be good for undervalued equity indices, gold, tips, and commodities, which have been hit directly by this recession, but whose values are historically low compared to other asset classes. So they're intriguing in the future. And the bad outcome would be for bonds in the future.
Very good. All right, great. Steve, thank you very much again for sharing your insights with us today. Steve and I will be back next weekend with another edition of our 3 Edge Weekend Update. As a reminder, all of our videos are available on YouTube, and you can simply go to YouTube, search for 3 Edge Asset Management, and don't forget to subscribe and select the bell icon in order to receive notifications as our new videos are released. Importantly, please feel free to share these videos with anyone who you think might be interested or could benefit from them. So on behalf of Steve and everyone at 3 Edge Asset Management, we'd like to urge everyone to stay strong, stay safe, and keep the faith. Thanks for listening.